Welcome back to the Deep Dive. It is February 2026, and let's be honest, if you have a pulse and a smartphone, you know the narrative. Artificial intelligence is eating the world. It's writing our emails, driving our cars, and probably generating half the memes in your group chat. But here's the strange part. If you open up your brokerage app and look for a pure-play AI stock, especially here in India, well, it's like looking for a needle in a haystack.
It really is. I mean, you have plenty of traditional IT services companies, the big consultancy giants, who have slapped now with AI stickers on their websites. And you have the global tech titans, where AI is a massive department, but it's still, just a department. But finding a company where AI is the oxygen, the entire business model from day one, that is incredibly rare.
Which is why today is going to be so interesting. We're unpacking Fractal Analytics Limited. Their IPO is open right now, literally as we speak, from February 9th to the 11th. And they are pitching themselves as India's leading pure-play enterprise data analytics and AI company. And honestly, the hype machine is in full gear.
It is, but our job is to look past the glossy brochures. We have a massive stack of documents here. IPO notes from HDFC Securities, SBI Securities, and a strategic market analysis that goes pretty deep. We need to figure out if this is a solid business you should own or if it's just a consultancy dressed up in a fancy AI costume.
So let's start with the basics. When I hear fractal, I think of those infinite spiraling geometric shapes. But what does this company actually do? Their tagline is powering human decisions, which sounds lovely, but a bit like a fortune cookie.
It does sound vague, but it's actually a very specific philosophical stance. A lot of AI companies today are pitching automation, replacing humans to cut costs. Fractal is pitching augmentation. They work with massive global enterprises to help the C-suite make better, faster, strategic choices using data. They aren't trying to fire the human. They're trying to give the human a bionic brain.
Okay, so they're the architects of decision-making. But how does that translate into making money? Because looking at the structure, it seems like they have a bit of a split personality.
Think of it as two distinct engines running under the same hood. Engine number one is Fractal.ai. This is the bread and butter. It accounts for about, 98% of their revenue. This is their services, business data engineering, analytics consulting, plus their own hosted platform called Cogentic.
Cogentic? That's where they keep tools like Trial Run, right? I saw that in the
Exactly. And Trial Run is a great example of why big companies hire them. Imagine you are a massive retailer and you want to launch a new pricing strategy. You don't just guess. Trial Run is an experimentation platform that lets you simulate and test that strategy in a safe environment before you roll it out and potentially, crash your revenue. It's safety rails for billion-dollar decisions.
So that's the main engine, services and safety rails. But then there's engine number two, which sounds way more fun, Fractal Alpha.
This is their moonshot factory. Fractal Alpha is where they incubate entirely near independent AI product companies. They build them, grow them, and hope they turn into unicorns.
I looked through the list of these alpha companies, and some of them are fascinating. There's Asper.ai for revenue growth, but the one that caught my eye was Queer.ai.
Queer.ai is the standout. It's an associate company, and it operates in the healthcare space. To understand the value here, put yourself in the shoes of a radiologist at 3 a.m. You've been looking at x-rays for 12 hours, you're exhausted. A patient comes in with a hairline fracture or a tiny nodule in their lung. The human eye might miss that.
But the AI doesn't get tired.
Exactly. Queer.ai uses deep learning algorithms to flag those abnormalities instantly. It's not replacing the doctor, it's tapping them on the shoulder and saying, hey, double check this spot. That is high impact, high value tech, and it's a totally different business model than just, billing hourly for consulting.
That distinction matters. But before we get too carried away with the futuristic stuff, we have to address the timeline. In my head, an AI company is usually a startup that was born in a garage in 2023 after ChatGPT came out.
Yeah.
But Fractal, they've been around since the year 2000.
That is a critical piece of context. They have been doing this for over 25 years. They survived the dot-com crash, the 2008 financial crisis, and the initial big data hype cycle. This isn't a team that just downloaded an open source model last week. They have deep roots in data engineering, the messy, unsexy work of cleaning and organizing data, which is actually the prerequisite for any AI to work.
Right, you can't build a Ferrari engine if you're fueling it with sludge. They've been refining the fuel for decades. Now let's talk about who's buying this fuel, because their client acquisition strategy is aggressive. They call it whale hunting.
Well, they politely call it the must-win client strategy, or MWC. But yes, they are hunting whales. They have very strict criteria. To even be on Fractal's radar as a target client, a company generally needs revenue over $10 billion, a market cap over $20 billion, or at least 30 million customer.
So no small businesses, no medium businesses, just the titans of industry. Why be so exclusive?
It's purely economics. Fractal's model is high touch. It requires expensive data scientists and lots of time. You can't scale that model with small clients who might churn in 6 months. You need clients with deep pockets who are embarking on multi-year digital transformations. You need clients who can pay the bills without blinking.
And looking at the roster, they have certainly caught some whales. We were talking Citibank, Costco, Mars, Mondelez, Nestle, Philips. But there is one group of clients that really jumps off the page. The notes say that as of March 2025, Fractal serves a majority of the Magnificent Seven.
Which is a headline-grabbing stat. For those who don't follow the markets daily, the Magnificent Seven are the tech overlords. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla.
It sounds incredible. It's like selling ice to Eskimos. Why would Google or Microsoft need Fractal to help them with AI? Don't they have the smartest AI engineers on the planet?
We should apply a little skepticism here. Yes, it validates Fractal's quality. Google isn't going to hire amateurs. But we shouldn't assume Fractal is building the core algorithms for Gemini or ChatGPT. More likely, they're handling specific, messy implementation tasks, data cleanup, or specialized analytics that the internal teams at big tech just don't have the bandwidth for.
So they might be the specialized plumbers ensuring the pipes work, rather than the architects designing the skyscraper.
Precisely. But even being the plumber for Google is a very lucrative position. And the data shows that once Fractal gets a foot in the door, they are incredibly hard to kick out. Their net revenue retention, or NRR, is 114%.
Let's break that down. NRR is basically the stickiness metric, right?
It's the golden metric in this industry. 114% means that if they didn't sign a single new client next year, their revenue would still grow by 14%. Just because their existing clients are spending more money. Their top 10 clients have been with them for an average of over 8 years. One relationship goes back 19 years.
In the tech world, 19 years is basically the Paleolithic era. That is impressive stickiness. But relationships only get you so far. Eventually, you need proprietary tech. And this brings us to what I think is the most misunderstood part of this deep dive. The difference between generative AI and what Fractal calls reasoning AI.
This is the crux of their technical pitch. Most people know generative AI like ChatGPT. It's a prediction engine. It guesses the next likely word in a sentence. It's fast, creative, and great for writing emails or code, but it hallucinates. It makes things up because it doesn't actually know facts. It just knows probabilities.
Right. It's like that smooth-talking friend who sounds confident but might be totally wrong.
Exactly. Fractal is betting on reasoning AI. These are models designed to think step by step, verify facts, and solve complex logic puzzles without hallucinating. They are building their own foundation models specifically for this.
And they have the hardware to back up the claim. They have a model called Fathom R114B. And in the source material, there is this story about Project Ramanujan.
This was a big win for them. In 2024, their reasoning model entered the Meta Hacker Cup at NeurIPS. NeurIPS is arguably the most prestigious AI conference in the world, and Fractal's model won the inaugural competition for reasoning.
That seems like a big deal. Winning at NeurIPS isn't marketing fluff. That is peer-reviewed combat.
It proves they aren't just wrappers for OpenAI. They have genuine R&D chops. And that victory likely played a huge role in them getting selected for the Indy AI mission. The government of India has tasked Fractal with building the country's first large reasoning model, spanning up to 70 billion parameters.
So they have the government contract, the awards, and the clients. Let's talk about the money. The IPO is asking for our cash. What are the numbers telling us?
Okay, so the IPO price band is 857 to 900 rupees per share. At the top end, the company is valued at roughly 15,474 crore rupees, so around 1.8 billion US dollars.
And the growth story.
It's solid. Revenue grew at an 18% compound annual growth rate between 2023 and 2025. They hit over 2,700 crore rupees in fiscal year 25. But the really interesting story is the profitability flip.
I saw that. They were in the red in FY24, and now they're in the black.
Yes. They posted a loss in FY24, but swung to a profit of 220 crore in FY25. They improved their operational efficiency, basically tightened the belt, and got their EBITDA margins up to around 12.7%.
But there is a number in the cost structure that made me pause. Employee benefits expense. It's eating up 72% to 75% of their revenue. That feels high.
It is high, and this is the reality check for the listener. Despite the AI label, Fractal effectively operates with the cost structure of a services company, not a software company. A true software company builds code once and sells it a million times with near zero marginal cost. Fractal has to pay smart, expensive humans to deliver their value. That 75% cost line means their margins will likely never look like Microsoft's or Adobe's.
Which is a perfect segue to the risks. We need to look at the bear case. I was reading the note from SBI Securities, and they rated the IPO as neutral, not buy, just neutral. Why the hesitation?
Valuation. Plain and simple. At the upper price band, the price-to-earnings ratio, the PE, is somewhere between 73 and 79 times.
79 times earnings. That is aggressive.
To give you context, traditional IT services giants like TCS or Infosys often trade at a PE of around 20 to 25. So you are paying a Ferrari price for what is structurally still a services business. You're paying for future growth that hasn't happened yet. If they miss their earnings targets by even a little bit, that stock price could correct violently.
And what could cause them to miss? Let's talk about the too many eggs in one basket problem.
This is the single biggest operational risk: client concentration. Their top 10 clients contribute about 54% of their total revenue.
More than half the revenue from just 10 accounts.
Correct. And the largest single client accounts for over 8%. Imagine if that client gets a new CEO who decides to cut costs or decides to move their AI work to a competitor like Accenture. Fractal loses 8% of its revenue in one phone call. That is a very fragile position.
There's also the talent war. We mentioned how expensive their people are. What happens if they leave?
The attrition rate is around 15 to 16%. In this industry, your inventory goes home every night. If Google or Microsoft decides to go on a hiring spree in India and offers double the salary, Fractal loses its key asset, its brains. They are constantly on a treadmill of hiring and training just to stay still.
And then there is the existential threat mentioned in the strategy report, in housing.
This is the irony of AI getting better. As tools become easier to use, as reasoning agents become commodities, do clients still need Fractal? If a bank can just subscribe to a super smart AI agent for $50 a month that does the work of a junior data scientist, why pay Fractal millions?
So Fractal has to constantly sprint up the value chain to stay relevant. They have to solve problems that are too hard for the easy AI to solve.
Exactly. They cannot afford to be average.
So knowing all this, the high price, the concentration risk, but also the incredible tech and client list, what are they doing with the IPO money? They're raising about 23 crore.
A decent chunk is going to pay off debt in their U.S. subsidiary, about 264 crore. That's boring financial hygiene, but it's smart. It de-risks the balance sheet.
Then the rest is for growth.
Yes. They're expanding offices in India, but more importantly, they're putting 355 crore into fractal alpha and inorganic growth. They are betting that if they pour money into sales and R&D for those moonshot products, one of them will pop and justify that high valuation.
They need a blockbuster product to escape the services company trap.
That is the bet investors are making.
So let's wrap this up with a big picture thought. We have Fractal, an Indian multinational playing in the big leagues, profitable, sticky clients, but expensive and heavily reliant on a few big whales.
It represents a shift from AI hype to AI utility. These guys aren't selling dreams, they're selling engineering. But the price of admission is steep.
Here is my final provocation for you to chew on. We talked about agentic AI software that can reason, plan, and execute tasks on its own. If Fractal succeeds in building these agents, does their own business model break? Currently, they bill for hours and expertise. But if the expert is a piece of software that runs 247 for pennies, clients won't pay for hours anymore. They will pay for outcomes.
That is the billion-dollar question. If I can buy an AI agent from you that saves me $10 million in supply chain costs, I don't care if it took you 5 minutes to install it. I'll pay for the result. If Fractal can pivot from we sell smart people to we sell guaranteed outcomes, they could be the next global tech giant. But if they cling to the hourly billing mindset while AI drives the cost of labor to zero, they are in trouble.
It's the classic innovator's dilemma. Can they disrupt themselves before the market does it for them?
We'll have to watch and see. It's going to be a fascinating few years.
It certainly will be. That's it for this deep dive into Fractal Analytics. We hope this helps you navigate the IPO noise. Thanks for listening.
Keep questioning.